PE multiples are going up because there are fewer deals. There are more PE companies because a few years ago there were a couple thousand. Now I think there's over 9,000. There's about $3 billion in what they call dry powder sitting on the sidelines right now looking for deals to invest in. The way private equity funds work, does anybody know how private equity funds work as far as how they raise their money? So, yeah?
I think they establish funds.
They establish a fund.
Returns to people who can't get as good a return in the market.
Yeah, so what they do is it's a fund for a fixed period of time. So they're typically 7 years. And at the beginning of it, they solicit people who say that they will invest, and then they don't actually invest, but the company goes out and the private equity fund goes out and looks for companies to buy. When it finds one, it does a capital call. And so it says, hey, you know, Luke, you said you were going to invest, I need $1 million now, you committed $1 million. And then he pays his $1 million in, and you pay your $1 million in, and so on and so forth. They buy the company. Now, over the next period of time, before that 7 years ends, they've got to acquire a company, grow it, and sell it. Because at the end of the term, they've got to sell everything and give everybody's money back, whether they made money or not, right? And the PE company, the private equity fund, really only makes money. They usually make 20% of the profits after people get their money back. So they only really make money if they perform. Now, that's a really sweet deal, though, because there's all this leverage out there. So now there's almost 10,000 private equity companies chasing all the same deals that just a few thousand were a few years ago, right? And they only really want big deals. So typically a private equity fund is only going to look for a deal that has 10 million in EBITDA, or 10 million in top line sales, or 2 million in EBITDA. And if it doesn't have that, then it's just too small a deal, because it's almost the same amount of work to do a $1 billion deal that it is to do a $10 million deal, okay? So let's look at performance. If you look at the returns, and I went and found the highest savings account return that I could find 2 weeks ago. It was 1.09%. You guys are probably getting, 3-4%. But Treasury's only at 1.7, money markets at 2, T-bills at 3. Even the S&P over the last 10 years only averaged 8. If you bought and sold real estate, you would be around 10.6. REITs, real estate investment trusts, do a little bit better at 11. But I'll show you that buying small businesses to medium-sized businesses, SME, small and medium enterprises, will get you about 44 on the low side. And I'll walk you through how that works. But that exceeds savings by about 4,000%, beats the S&P by 5 times, and still 400 and some percent better than real estate. So, Dan, why are we going to buy versus startup?
Well, you always have just a choice of buy or build, so it's less risk. You have financing options available, brand recognition, instant customers, instant sales, instant profits, instant contacts, and instant systems, instant employees.
Yeah, so, I mean, if you think about it, and this is what we were talking about earlier, why start something from scratch when you have to build all this stuff if you can just get it, especially if they're almost giving them away right now? So, 90% failure rate for startups. 90%. First year, 10%. You'll hear 90% fail in the first year. That's a made-up statistic by marketers. 70% fail in the second year. By the way, all these stats and everything I give you, I am a stickler for detail. So you'll see I footnote every single resource. You can see everywhere every bit of information I give you comes from, because I hate it when people say 90% of this, and then I'm like, based on what, right? Yeah. Okay, so you don't have to worry about that here. But even the fancy, smart VC guys fail 75% of the time, right?
Isn't that incredible?
So then we look at why businesses fail. If you read that, you can tell me the biggest reason, but tell me some of the reasons that you think businesses fail.
No market, undercapitalization.
That's brilliant. Undercapitalization, money, yeah. You guys?
Grow too fast.
Grow too fast?
No management.
Poor product, no management? Disruption. Okay, great. So 42%, that was really good. I don't know how you got that. Psychic. 42% market demand, 29% run out of money, 23% don't have the right team, 19% get out-competed. Obviously, these are the factors. It's not like it adds up to 100, if that's confusing to you. 18% based on pricing and cost issues. 17% just didn't have a user-friendly product. And then 17% also had a product with no business model, which isn't surprising because inventors like to go into business. We think of something, we say, oh, this is a cool product. We don't think about the demand for it. 14% from poor marketing. And then in terms of success rates, 10% success rate for first-time founders. If they failed once before, they generally learn something, and the second time around, they're twice as successful. And then the VC people we know have a 25% rate of success, but previously successful founders, 30% chance of success. So even if you have been previously successful, you've still got a 70% chance of failure. And then how much money usually goes into starting businesses? Well, 33% less than 10, those are either going to fail because they don't have enough money or they're just really super small. And then 12%, 250 more, usually that's done through some sort of angel or seed or VC funding rounds. But the vast majority, over 50%, are in the 10,000 to 50 range and the 50 to 250 range. And most of these go up into the 50s and most of these go down to the 50s. So it's really in that 50, 60K range that most people are investing to start a business, which isn't outrageous, right? So let's look at the difference money-wise. If you invested either 50K in an acquisition or 50K in a startup, and you got leveraged funding, on average you would get 950K in an acquisition, and in startup, the average startup has 165K. Again, all the sources are down at the bottom. And our valuation here would be $1 million, here would be $199 on average. The profit margin's about the same on average across all of these types of businesses. And EBITDA STE runs about 357 on average for the acquisition and 71 on the startup because this business has already gone through the startup phase. This business might very well get here. It's started up, right? So you go in with momentum, and in business, momentum is critical.
Roland, can you explain the leverage funding on the acquisition of 950?
Yeah, so basically, this is the leverage that's used to buy the business, and this is the leverage in borrowed money that's used to fund the business. Which makes sense also because you can't borrow as much when you're starting up as if you're buying a business. Okay? And this business already went through the phase of this plus whatever growth borrowing it did. Okay?
Can you give me an example of a leveraged funding source in an acquisition, like earnouts?
Well, even SBA.
SBA, seller
Yeah.
carry, you can, yes.
Yeah. I'll give you 159 of them later today. Okay? So the other thing I want to talk a little bit about is the O myth. How many of you have read the E myth? That's really cool. I love that because Gerber lives here, in Escondido, not too far from here, and he's a super nice guy. Great book. My challenge with it is that I think it's great because we know that most people work in the business. They're making the coffee and serving the customers and sweeping the floor and stuff like that. And Gerber teaches, no, you should be working on the business. You should be hiring operators, installing systems and stuff like that. My argument is that really, if you're doing that, you're still selling the product of the business. And what I suggest you should be thinking about is that the business itself is the product. That you should be working above the business, not on it. That you should be finding investors. You should be thinking about acquiring competitors, integrating your supply and distribution chain through acquisitions and mergers, acquiring new verticals, right? Working above the business, when you start thinking about that the product that you have is the businesses that you own and not the products that those businesses sell, you think differently, okay? And you can make a whole lot more money selling businesses than you can make selling products.